Okay guys, so in this video we're going to talk about should you invest during these current times. So I recently received a comment on my channel asking if I thought that this was a good time to invest. So before I give you guys my response, I just want to give you guys a quick background of what's been going on in the markets in general. So of course, due to the whole coronavirus situation, I'm looking at a current Dow Jones chart. So as you can see, Dow Jones basically fell off a cliff. And then we came out with the CARES Act, the $2 trillion stimulus package, and that kind of sent the stock markets on a bit of a rally, but a lot of that was a simple short squeeze because a lot of traders were simply shorting these stocks. And of course, with the good news and the short squeeze, now we're up a bit. So now we're kind of like literally halfway where we were before. So if you see, if I were to if you guys focus on this, we're at 23,000 points, the Dow Jones. So we're well off the 18,000 low, but we're well off the 29,000 high. So a lot of investors are wondering, should I invest during these times? So if you're a beginner investor and you've never invested before, perhaps you're a little bit more interested since stocks have been performing a lot better over the last 2 weeks. That's normal. It seems like most people are interested in investing when the stock markets are going up instead of when they're crashing. So I'm going to do my best to give you guys an honest opinion on what I think is going to take place within the next few months. And if you guys want some more videos, please check out my description because I'm going to link to some of the videos I'm going to reference. So let's get into it, guys. So the number one thing I try to look at when I think about is this a good time to invest or not is I try to look at the Buffett indicator. So for you guys that aren't familiar with Warren Buffett, he is one of the most famous investors of all time. He's the CEO of Berkshire Hathaway, and the man has been working with his company in Nebraska for 40 to 50 years, and he's turning 90 in August, so he's very, very experienced. What I want to do is I want to pull up his indicator. So Warren Buffett, guys, he came up with this indicator to determine whether or not he thinks stocks are overvalued. So according to Warren Buffett, he says, as pointed by Warren Buffett, the percentage of the total stock market cap, so you've got the total entire market cap of all of U.S. stocks relative to the USGNP is probably the best measure of where valuations stand at any given moment. So guys, obviously to calculate this ourselves would be kind of complicated. So what I like to do, I like to go to Guru Focus, and you guys can find, I'll put the link to this in the description, but you simply head over, you can just Google Guru Focus Buffett indicator. So what you can see here in this graph here is basically we're looking at a graph that is charting the total market cap of the Wilshire total stock market, and then we've got the USGDP. So guys, this chart, we're basically looking at the historical ratio. So if you look at the current ratio right now, according to this, it says the stock market is significantly overvalued. The total stock market cap over GDP is around 128.6%. So now guys, I want to actually show you that ratio. As you can see over here, you take a look at the chart. So the last time that the Buffett indicator was really overvalued, we had the dot-com crash. And then the last time the Buffett indicator was undervalued, that's when stocks basically rallied and we went on this 11-year bull market. So if you take a look at this indicator, guys, according to this, it says that stocks are still slightly overvalued. So that is definitely something to keep in mind. And now that a lot of economists predict that we're heading into a recession. We officially we're heading into a recession in March, and the U.S. is going to be heading in a recession as long as we have this lockdown and coronavirus cases are increasing. It looks like that the GDP will be headed lower as well. So the stock market is already corrected a bit, and now our GDP is going down. So what I like to do is I like to take a look at this ratio, guys. It really provides a lot of insight on how much I think stocks are either undervalued or overvalued. So guys, what I want to talk about is I want to talk about a couple different types of investments that are becoming more popular now. So I think everybody thinks you have to invest in stocks, and that's not true. I think depending on your age and depending on your risk tolerance, you should always consider long-term treasury bonds as an option. And right now, long-term treasury bonds are doing very well. A lot of these long-term treasury ETFs and long-term treasury index funds are doing very well. So let's say you look at this ratio and you think, hey, stocks are too expensive and perhaps we're going to suffer another stock market crash. You guys can check out that video in the description or how I talk about, I think we'll have another crash due to the reaction to earnings. It's probably going to be pretty bad, especially in Q2. So what I want to give you guys is some options. Now, before I talk about what percentage of bonds you can get into, there's usually the rule of 100. So I want to talk a bit about the rule of 100. Okay, so what exactly is the rule of 100? Well, the rule of 100 is also known as the rule of 100 minus their age. And it says, for years, a commonly cited rule of thumb has helped simplify asset allocation. It states that individuals should hold a percentage of stocks equal to 100 minus their age. So for a typical 60-year-old, 40% of the portfolio should be stocks, and the other 60% should be bonds and other safe assets. So guys, let's take a look at this chart that I found on Google. So for example, if you are 30 years old, then this is very conservative now. You should be about 70% stocks, 30% bonds. And as you guys can see, depending on as you get older, you reduce your exposure to stocks and move more into bonds. So what is going on here is the fact that you can still invest, but you don't have to necessarily invest in stocks if you think things aren't going to do well in the short term. So now I'm going to give you guys a couple safe bond ETFs and index funds that I personally like, that I think you can put your money in if you think the stock market's going to crash again, or you're nervous and you just want to earn a consistent return without risk until the dust settles on this whole coronavirus thing. So I use Fidelity for my retirement account, so I'm going to give you guys my favorite Fidelity index fund for long-term treasury bonds, and then I'm going to give you guys an ETF as well. So let's get right to it. So my favorite index fund on Fidelity is the Fidelity Long-Term Treasury Bond Index Fund, ticker symbol FNBGX. Now this fund has been doing absolutely excellent. Year to date, it's actually up 21%. So while a lot of people have been losing money in stocks, this fund has actually been going up. And as you can see here, over the last 10 years, the fund is returning 8.9%, guys. So this fund is very conservative. It just invests mostly in long-term treasury bonds. So you're not going to get, obviously, the returns that you're going to get with stocks, but you're still able to put your money away and invest and earn a return. And it's going to be a lot more than any return that you could earn in like a traditional bank like Bank of America or Wells Fargo or something like that, because those banks are basically paying no interest. So if we take a look at the expense ratio, it's very low because this is an index fund, guys. I never buy mutual funds. I think they're too expensive. I prefer low cost index funds. So this fund expense ratio is 0.03%, very cheap. So you can park your money here. This fund has been doing very, very well, and that's because investors have been running to the safety of long-term treasury bonds. So if you're worried about, you don't want to invest in these times, and if you are on Fidelity like me, this is a great option. Now, for you guys that aren't using Fidelity, I'm going to give you guys an ETF that you can buy. So if we type in the ticker symbol, let's head over to Yahoo Finance. This is a good long-term treasury ETF. So what an ETF is, it basically trades on the New York Stock Exchange. It's like an index fund, but it trades, so you don't have to have a Fidelity account to buy it. So this is the SPDR Portfolio Long-Term Treasury ETF as well. And this one has performed just as well as a year-to-date return of 21% and an expense ratio of 0.06%. So that ticker symbol is SPTL. So guys, those are two options that you can have if you're not ready to invest during these times and you don't want to put your money in just cash and earn nothing, but you don't want to put your money in stocks and risk suffering some loss. Okay, so for me personally right now, I'm going to be picking up that Fidelity Long-Term Treasury Bond Index Fund that I mentioned, ticker symbol FNBGX. I'm going to be adding that to my retirement account because I do have a little bit too much exposure to stocks. I'm probably 90% stocks right now, so I want to adjust that allocation because I feel like this run-up could be mostly a short squeeze, and I'm not 100% consistent with that because, as you guys saw on the Buffett indicator, if we're in a recession and the GDP is going down, stocks could be going down further. But It really is up to you guys. If you're younger, some of you guys out there, I know you guys are very young. Maybe it's your first time investing. You're still in college age, or you just got out of college. You're in your early 20s. This would be probably a time you're going to be thinking very long term here. So this would probably be a time for you guys to pick up some stocks on cheap. Because for you guys that are really young, it's really time in the market that's the most important thing. For my viewers, you guys in your 30s or 40s, this is probably a nice time to get involved in bonds. You don't want to lose a lot of your portfolio gains if the market does tip back down again. And there's nothing wrong with bonds. As you saw, guys, these bond ETF index funds are up 20%. So while a lot of people were dealing with losses, the people that just took all their money out of the market and put it in bonds, they're doing pretty well right now. And then for my viewers that are over 50 or so, really consider moving a lot of your money in towards bonds right now. Right now it's better safe than sorry. A lot of those bullish stock market gains we got, that's in the past, guys. This is a new era right now. We're dealing with new social distancing matters, 5G, and a lot of things like that. So the world's going to be different in the future. So there's nothing wrong with in the short term being a little bit conservative and investing in some conservative assets like long-term treasury bonds or cash savings account that I use. Obviously, interest rates are pretty low right now, but it's earning about 0.26%, so it's still paying more than traditional banks. So if you guys are so conservative and you don't want to invest in anything right now, that would be the best option. So I hope this answered that question, guys. That's my opinion on this. Like I said, I'm really not sure where the markets are going to go in the near future, but I want to give you guys as much advice and as many options as possible to protect yourself, because in any situation, there's always a bull market somewhere, and it looks like those long-term treasuries, that's where you're going to find it. So I hope you enjoyed this video, guys. Please smash that like button and give me a thumbs up if you enjoyed this content. And please subscribe to this channel. I post videos every day on the markets. I try to answer your questions, and I tailor my content specifically for subscribers and viewers like you. So that's it for now, guys. Hope you enjoyed this video, and take care.